that to happen. So there were a few floating members. I think I've got everybody attached now. So if you're not in a group, put your hand up now. Everybody's in a group, right? May I ask you the second question, and some honesty would be nice. How many of you have not picked a company yet? How many have not picked a company yet? Really? Okay. So you know what I'm going to do is I'm going to pick on you and ask you about your company. And you better make up a company when I ask you, because otherwise you'll have to make up stuff as you go along. So right after class today, I'm going to shoot out of here because I'm supposed to be on Fast Money on CNBC, and I am not looking forward to it. And I'll tell you why. I was supposed to come in and talk about Tesla today, which is always fun. You dance around you know what they're going to ask me. This is the problem with Fast Money is the events of the day drive the questioning, and today I have absolutely no doubt what the question is going to be. So you're going to go in my stead, and I'm going to ask you the question. I'm trying to dig to find out what your answer is so I can steal it and give it So you ready? You come into CNBC, they make you wait in the green room, which is neither green nor a room, but they call it a green room. Don't ask me why. Then they make you go in front, and Fast Money is actually at the NASDAQ. They have this, so you have 5 people on a desk, and you get to stand, and spotlight's on you. So here's my question. Market was down, or it was, when I last checked, 840 points about 20 minutes ago. It was, but 840, 20 minutes ago. It's now back to over 1,000, or was it? Okay. So it's down 3.5%. Okay. Can fundamentals explain what happened to the market today? They call me Dean. I don't even know, but that's become my name, Dean. I don't even know why they call me Dean. Dean with, can fundamentals explain the 3.5%? Before you're too quick to say no, what's at the core of today's drop? What's causing it? This is the first viral market collapse we've had, I think, in history. SARS created a much more slow running. This is the coronavirus and its spillover effects. And if the coronavirus were in Kazakhstan, and even if it were a pandemic, I don't think we'd be seeing the kind of reaction. The fact that it's in China essentially creates ripples that go everywhere. Remember I said China is pretty much the answer to every question? This time it is, right? Do you know that, if you look at the S&P 500, 11% of the S&P 500 revenues now come from China. And if you look at companies like Apple, it's 20%, and Qualcomm, it's 67%. Nothing is going to stay China-specific. For the last 20 years, China has become the engine that drives global growth. 40% of all global growth came from China. Without China, you take that growth out, the 3% becomes 2.2%. So the first thing that has to factor in here is this is something that, if it plays out, is going to have huge consequences, not just in terms of revenues. Walmart doesn't have much revenues in China. But what does it have exposure in China to? You go, after class today, make this your fun exercise, find a Walmart. I don't even know where that is. Yeah. Oh, you'll find one. Just put in your address. It'll take you there. Get into Uber, say, take me to a Walmart. Okay. Go in and start checking products on the shelves. What are you going to see? Made in China, made in China, made in China. Walmart might not look like they have exposure, but they have exposure through supply chains and production. So could the 3.5% be explained by fundamentals? The answer is yes. Could it be explained by fear? The answer is yes. I think it's both. You're saying how will we know which one's what? Fear recedes, right? So fear you will see go up and down. So it's a pure fear factor. This is the kind of thing where people say buy on the dip and just hold on, the fear will disappear. This is not a dip that's entirely fear driven. And we won't quite know which one it is until we start to see the numbers come in. Like what? When the revenues come in, the earnings come in, and when companies start to act, cutting back buybacks and dividends, then the fear has become fundamentals. Okay. My guess is that it's a big chunk fundamentals and a significant amount of fear. The fear will go up and down depending on what the news story of the day is. The fundamentals, you'll start to see the numbers going, and you're going to get to see it in your company's numbers as the first quarter numbers come out and as the company makes announcements. What does this all mean? No, basically that's what they're going to ask. Should I sell? That's basically they want an answer. Sell, buy, do something. And here's my response. I've discovered that whenever I do something in the midst of a crisis, it's almost never the thing I should be doing. Right? It's just, that's for me. So my reaction when I have a crisis like this is, no, maybe I should be selling, but I've realized historically that if I go sell right now, I almost always look back and say, I wish I hadn't done that. So what I'm going to do is turn off all market news for the next week. You don't have that option. You have stocks to analyze. You got to track it. I don't have to. And kind of take a holiday from the news, because often the worst thing that happens in a crisis, you get caught up in the mood of the moment. Next thing you know, you're acting in ways you shouldn't be, and the whole thing implodes on you. So here's my exercise for you. You got that equity risk premium I did at the start of February, right? When you redo it this evening, it's going to look very different. You're going to have a 3% drop or 4% drop in the index since the start of February, so that lower index. What else happened today? Stocks dropped. What happened to the T-bond rate? Check it out. It's down to like 1.3%. Remember it was 1.92% at the start of the year? Risk-free rate is lower. Stocks are lower. And you're going to notice a flaw in the spreadsheet, which is the cash flows and the earnings are kind of stuck, right? Why? Because they don't get updated every minute of every day so you're actually going to probably overestimate the equity risk premium. Why? Because you're leaving the cash flows at what they were before this hit. And that number you're going to start to see play out more gradually. So my guess is if you compute the equity risk premium at the end of today, you're going to get a number which is 20 basis points higher, 25 basis points higher than it was the start of the month. Which means if you're valuing a company next month, the equity risk premium should be much higher than what it would have been if you did the valuation 2 weeks ago. Get used to that volatility, because that's what crises do, is they roll through the price of risk. So now any other question? Oh, one other thing. I have the unpleasant duty to remind you that a week from today, something momentous will happen. You know what I'm talking about, right? If you've been checking your calendar, what's a week from today? The quiz. You're saying, the quiz? What quiz? I didn't even know there were quizzes in this class. No. You can be in denial, but there will be a quiz. Right? So this email after the class today, I will send you 3 things. One is I will send you a link to a review session that I do for the quiz. Unfortunately, doing a physical review session is going to be tough for me simply because I'm going to be gone Thursday and Friday to Europe. So I've done a webcast review session. It's about 35 to 40 minutes on the topics. I also have every past quiz I've ever given in this class and the solution to every quiz. So you can see what the quiz ones have looked like since 1997, I think. Why 1997? Because I used to give midterms until 97, so I started giving quiz ones, which means you can't complain that you don't have enough practice quizzes. Okay? So I'll send you the link to the past quizzes and the links to the past solutions. And my suggestion is you start working through at least a few of them. Initially, you can cheat. You know what I mean by cheating? Look at the problem, look at the solution. Everything's going to look obvious when you do that. And then try to work through them on your own. And then turn off the solutions entirely. See if you can work through on your own. Because that's what the real quiz is. There will be no solution you can check, I hope, while you're working on the quiz. It is open book, open notes, but that's kind of delusional. If you say it's open book, open notes, let me check the notes after I show up next Monday, because it's 30 minutes, first 30 minutes of class. And 30 minutes passes really fast, especially when you're taking a quiz. So if you're checking notes, you're going to run out of time. Okay? So I will send you the information on the material for the quiz, the pages in the lecture notes. We will cover past quizzes. And I will also send you a seating chart for next Monday. Basically, I've got 260 as well for the 30 minutes. Because if you look around you, taking a quiz in this room and everybody is in here, and not everybody is in here today, is a pain in the neck, right? You're into each other's spaces. There's no. So What I'm going to do is move about 90 of you into 260. 260 fits 170 people, so you'll have enough room there. So that'll allow people in this room to have 2 seats instead of 1 seat, so you can put stuff on the next seat. It'll give you a little more room to kind of write your, work on your quiz. But it's open book, open notes, open iPad as long as you keep, or tablet as long as you're just checking out the PDF version of your notes. So no Excel. So that's the honor code, because I know on your iPad you can open up Excel without me knowing. So you can't run Excel. And I've written the quiz in such a way that you really don't need a computer. The quiz is not about can you work out a 16 function equation. It's pretty straightforward in terms of the number crunching. But it will not be multiple choice. So you'll see that very quickly as you work through past quizzes. Will the next quiz look just like the past quizzes? Do I look stupid? I mean, if it's open book, open notes, and I just replicated past quizzes, you just have to find the problem that looks like just this one and look at the solution. It'll look, I would say, you know what a docudrama is? Where you take something in the real life and make a movie about it with one twist on it. This will look like a past quiz, but with a twist on it, one small twist. So if you prepared well from past quizzes, you should be able to get through 80 to 90% just based on that preparation. But the last 10% I want you to figure out, which is the way it should be. Otherwise, it'll just be whoever mechanically went through the quizzes get through it. So that'll be next Monday, first 30 minutes of class, so please don't be late. Because if you're 10 minutes late, that's 1/3 of the quiz gone. And watch for the email that I'll send out today. So today we're going to continue to talk about cash flows, and we're going to talk a little bit about money-losing companies. Okay? So let's say you have a money-losing company, and you're thinking about normalized earnings by taking the average earnings over the last 5 years. And many people do that for money-losing companies, especially for a company that has a history of making earnings. It's normalized earnings. Which of the following assumptions would have to hold for this to work in your valuation? The first is, the loss was unusual and the company has historically made money. Second, the problems that caused the loss were temporary and have largely been resolved. Third, the business has not changed in fundamental ways. Fourth, the company has not scaled up or down. You know what has been scaled up? It's not become much bigger or much smaller over the period. Which of those assumptions will need to hold? All of them. When people normalize earnings by average earnings, they are implicitly assuming all of those. That this company historically has been healthy. So when you do this for Boeing, which I don't know whether anybody's doing Boeing, last year they were a money-losing company for obvious reasons, the 737 MAX and all the problems that came out of it. You'll be tempted to just replace with the average of 5 years, and there's nothing wrong with it, but think through it. Is the 737 MAX a one-time, a temporary thing? You're going to reverse back to what they used to be. And I'm not saying that's a good or a bad assumption, but you need to be clear about the assumptions you make, because often we average things, we don't think about the assumptions we make. Today also we might get to free cash flow to equity, or we might not. Okay? When you look at valuing equity in a company and you project out free cash flows to equity, sometimes you will get negative free cash flows to equity. In other words, what you get in cash flows in the firm is not enough to cover the reinvestment needs, and you'll have negative free cash flows to equity. And you discount the free cash flows to equity to get the equity today. So basically, in traditional discounted cash flow valuation, negative, positive, it doesn't matter. You take the present value, you come up with the value of equity today. But when you have a negative free cash flow to equity in your discounted cash flow valuation, what are you implicitly assuming the company is going to be able to do that year? So let's say in year one, you show a minus $1 billion free cash flow to equity for Tesla, which is potentially, which is likely because they'll have to build new plants. When you show a minus $1 billion as free cash flow to equity, what are you implicitly assuming the company is going to be able to do in year one? It's just a number on the spreadsheet, but a minus $1 billion means that you assume that the company will be able to raise money in year one. And if it is negative cash flows, raise money in year two. Now, when you do a discounted cash flow valuation of a young company, this is implicitly built into your valuation that this company can not only keep growing, but be able to keep raising money to cover its negative cash flows in year one, year two, year three, year four, year five. Could that assumption get you into trouble? Is it possible that you're exactly right in every single one of your estimates, and when you get to year one and you have a minus $1 billion free cash flow at equity and you go out to raise capital, that you're unable to do it? Yeah. In fact, this is exactly what happened in 2001 when the dot-com boom bust. A lot of young companies, which you thought were going to be these high-growth, monstrously successful companies, went out in 2001 to raise capital, but capital markets had shut down. Remember, these companies can't borrow money, so it's got to be equity. And if you're a private company, that equity has to come from venture capitalists. If it's a public company, it has to come from you issuing stock. And all of that is built on the premise that equity markets are healthy and welcoming. And if that breaks down, you very quickly say, so if you're a Casper, today you're holding your breath. You see why? Because for Casper to become a large, successful company, it'll need to act. Peloton, you take the whole list of companies, Uber, all of those companies are dependent on equity markets staying open, and they're all saying, please, let this not be a drop in the equity market that's long and depressing because we won't be able to raise capital. So DCF valuation, people just assume cash flow is a cash flow, but we make implicit assumptions when we do things that we don't actually think through, because sometimes those assumptions can get us into trouble. Any questions on either of those? Because we're going to start today by going back and talking about the other half of the adjustments. So last session we were talking about converting leases to debt, and I want to make sure everybody at least understands why we're doing it. Leases, when you sign a lease agreement, you enter into a contractual commitment, and when you enter into a contractual commitment, failing to pay it will get you into trouble. So essentially leases are like that. So what do? We take all lease commitments and we bring them back to today using the pre-tax cost of debt as the discount rate. As I said, I've been doing this for 30 years, but in 2019, finally IFRS and GAAP is going to require companies to do exactly the same thing. So many of you, when you look at your balance sheets, if you have a US company or a European company or even some Asian companies, will now notice in the balance sheet an item called right of use lease debt, which is basically accountants trying to do what I did last week with the GAAP. But one of the things that I did this year, I was actually collected the accounting lease debt that was reported in balance sheets, because the first time in 2019 they were. And I did my own lease calculation to see how close or how different it was. And my numbers were off by about 20% in either direction depending on the company. And there's a reason for that. The way I did it was pretty straightforward. With every company I did exactly the same thing. Take the lease commitments. The accounting rules for lease conversion to debt are a little more complicated. Why? For two reasons. One is accounting has to balance the status quo with change. Why? Because you have all these accounting rules driven by how accounting treated leases for the last 100 years, and now you're changing the rules. You can't make it too wrenching, so they have this transition period where things adjust. The second is when accounting talked about converting leases to debt for the first time in 1949 and continued to talk about it, retailers and restaurants with these big lease commitments said, you can't do it. If you do it, you will ruin us as companies because we'll now have to show the debt. So there's that pushback that they've had from sectors saying, hey, you got to smooth the fall for us. So they've tried to make it less onerous for some companies by saying, for instance, if you have a lease with an escape clause, right, where you can actually get out of it, they said you don't have to count the lease commitments beyond that because technically it is not as onerous. So some of the reasons for the complexity come from status quo, and some of it comes from from trying to protect some sectors from seeing too much of a hit. What I'm trying to say is, even though accounting claims that it's doing it now, I'm going to continue to do it myself because I know exactly, and I don't say it's the right thing, but at least I know what I've done. Whereas with accounting, I have no idea why the numbers vary across companies. But the logic for what they're doing is exactly the same as the logic for what I'm doing. So any questions about converting leases to debt? So if I gave you the Yankees for this season, maybe that should be the weekly challenge for this week. Pick your favorite sports team, work out the present value of contractual commitments to your biggest players, see what you get as a present value, and see how much debt your company carries. You should be able to do it, right? It's the same process. Now, yes, go ahead. Do you need to include what? The capitalized what? Well, if you decide to treat it as debt, you got to go the whole distance, right? I mean, you can't just treat it as debt for cost of capital. Not, this is debt. From this day on, anytime you use the word debt in the old context, you now have to include capitalized leases as part of debt. Yeah? Which also means that the enterprise value for retailers and restaurants is much higher than we've originally reported them to be, right? And that's the reality. We've taken your biggest assets and put them back on your books. Everything's going to change. Okay. Let's talk about R&D. Again, it varies across sectors. In technology, R&D is a huge expense. In oil, it's a huge. You're saying, what R&D? What's the analogous expense to R&D with oil companies? It's called exploration costs. Right? It's essentially like R&D because nobody explores to get oil out this year. You explore hoping to get oil out in 10 years. And if you look at the overall market, R&D expenses are about 10, 11, and growing. In fact, this is an old graph if you looked at R&D, because the types of companies that are big right now tend to be companies where R&D is how you grow. So I'll give you my logic for why R&D should be treated as a capital expense. And let's talk about why accountants screw it up so badly. The essence of a capital expense is an expense designed to create benefits over many years. How can anyone argue that R&D is not a capital expense, right? Because ultimately, what company does R&D expecting to get a benefit this year? R&D by definition like super capex, right? A pharmaceutical company does R&D now, its products might not even come for 10 years because it's got to go through the FDA approval process. So what do you think the logic is for accounting doing what it's doing? Which is, across the world, with small exceptions, R&D is expensed rather than capitalized. Why do you think accountants do what they do? About 10 years ago, I was invited to give the keynote for the AICPA conference. You know what happens at the AICPA conference? 1,000 accountants gather together, usually in Las Vegas, which is kind of ironic. You know? Why in Las Vegas? Because they have the biggest ballrooms. You can fit 1,000 people in. And they invited me to give the keynote. And this is as close to a vision of hell as I can get, right? Be trapped with 1,000 accountants in a Las Vegas ballroom. And I tried to give a presentation that would ensure that I would never get invited back. I said, 10 things in accounting, it's probably somewhere on my website, 10 things in accounting that I don't quite get. That was the title of this presentation. And I went through things like, why do you guys screw up leases? It's debt. And they gave me some thing about ownership and capital. But they said, that doesn't convince me. So I got into the R&D and I said, why do you guys, you told me that any expense that creates benefits over many years was a capital expense. I remember Accounting 101. And here you are violating that rule over and over again with R&D. Why? What do you think the reasoning is for accounting expensing R&D? Think like an accountant for a few moments, then snap out of it. Okay? I'm not sure, but it'd be tax benefits. That would be a supremely logical reason, right? Because it could be for taxes, you get a much bigger, that I would have gone along with. You're violating accounting first principles, but if you open the door, I should be expensing everything, right? So I wish that were the reason, but none of them would have dared to give that reason because the IRS might have been sitting in. But I don't think that's the reason. Anybody want to try? I don't know how many years, like if you So do it. It's definitely not 1 year, right? So if you're saying I'm uncertain about how many years, I'm using 10, you're using 1 in a pharmaceutical company. Who's going to be closer to the truth? I think I was sure it might be 8, and it's definitely not 1 year. You think physically, let's have a nuclear power plant and I build a physical plant. I know this is an extreme example. Do you think a nuclear power plant is easier to sell than a patent that I get out of R&D? Physical assets, I think we might have an illusion that we can sell it more. But at least, again, if you're saying liquidation, at least there's an aura of common sense to what you're doing. Think like an accountant. There's no common sense involved. Yes? Now we're on to how accountants think. They said the benefits were too uncertain. I said, really? Okay. So if I built a factory in Kazakhstan, would you let me expense it? I mean, Borat could come in and burn it down tomorrow, right? All kinds of terrible things can happen in Kazakhstan. Do you see where I'm going? If uncertainty is the dividing line, then I'm a technology company deciding to build a new computer tablet and I build a factory. You should let me expense it, saying, I don't know whether it'll actually play out. Only with R&D do they use this uncertainty thing. So if uncertainty were a dividing line, it's not just R&D. I should be asking this of every capex that I make. If it's uncertain, you should let me expense it, but you don't let me do it. So then they fell back on the typical accounting reasoning. They said, we just want to be conservative. You see the conservative part of expensing R&D? What happens to your income? It's lower with expensing R&D. So it's better to report lower income rather than higher, which I've never quite understood. I thought your job was to report expected income, not lower income or higher income. But is it really conservative? It is true, expensing R&D will give me lower income. But when you expense R&D, what do you show on your balance sheet? Nothing. If you don't capitalize it, it doesn't show up on the balance sheet. So when you expense your biggest capex, guess what you've done? You've taken your biggest asset off the books. So when I compute the return on equity or the return on invested capital of a technology company, guess what I get? Sky high numbers. You might be taking terrible projects, but because I've taken your biggest asset off the books, I'm going to give you returns of 85%, 100%. I don't think there's a good reason, let me be quite honest, for doing what accounting is doing. But you know how long it took them to do the right thing on leases? 1949 through 2019. Maybe in 2059, accounting will finally say, you know what, we should be capitalizing R&D. And I say, welcome to the club, but I'll be dead by then. So one of you has to do it by then. We can't wait for accounting to come to its senses. We've got to capitalize R&D right now. There is no debate to be had. We can debate about how we estimate how many years and what to do, but that's a healthy debate. So let's talk about the process by which you capitalize R&D. So you're a company, a technology company or a pharmaceutical company. Here's my first question to you, and it's not an easy question to answer. On average, how long does it take between the time you do R&D and a commercial product emerges? Notice how I threw the on average up front. I know some of your R&D might pay off 7 years, some in 9, some might never pay off. Just give me an average number. So if you're a pharmaceutical company, the answer to that is probably going to be really long. Let's say 10 years. If you're a computer software company, it might be 2 or 3 years. You don't wait 10 years. Here's the second step. Once you give me an answer, let's say 10 years, I'm going to go collect R&D expenses every year for the last 10 years. You say, why are you going back in time? Because if I decide to capitalize R&D, I can't act like I'm starting to do it right now. I've got to act like I've been doing it right from the beginning. Because let's follow through. If you believe R&D expenses take 10 years to pay off, what should you be doing with R&D expenses to be consistent? Rather than expensing them in the year in which you spend them, you should be expensing them over 10 years. I'm not going to try to get fancy and use double declining depreciation as some, I'll just do straight line, I'll just write off 1/10 every year. Do you see where I'm going to go? Let's assume that I do Cisco where I picked an intermediate, 5-year life. I got the R&D expenses for the last 5 years. So basically that's the R&D expenses for the current year, R&D expenses for the last 5 years. Here's what I'm going to do. Take the R&D expense from 5 years ago. Remember, I've been writing off 1/5, 1/5, 1/5, 1/5. I'm writing off the last 1/5 this year. It's gone. The R&D from 4 years ago, I write off 1/5, 1/5. I've written 1/5, and there's 1/5 left over. So I keep track of how much I'm writing off, which is always 1/5 of the expense, and how much is still left on the books. If you add the last column, you come up with you come up with 903 million euros. I'm sorry, it's SAP, not Cisco, otherwise it would be in dollars. 903 million euros. So that's how much I'd be amortizing this year of R&D from the last 5 years if I were trying to treat R&D as a capex at SAP. You're saying, what is the second last column? I get 2.9 billion euros. What does that mean? That is the capital I've invested in R&D that's still on my books. You know what I'm going to do? I'm going to put it on the balance sheet. But the balance sheet is a very unpleasant requirement. It has to balance, which means if I put this as an asset, which is what I'm doing, something has to change on the other side. When I did leases, debt went up, assets went up, because basically you see a leased asset and leased debt. Here, I've created an R&D asset, and on the other side, I have two choices, debt or equity. Which one should I raise by 2.9 billion? You got a 50-50 shot, go for it. I'm going to raise equity, and here's why. This R&D came out of net income, out of after debt income. So my equity will increase by 2.9 billion. So here's what's going to happen when I capitalize R&D. My operating income is now going to be different. My net income is going to be different. Whether it's higher or lower, we'll see what drives that. It'll be different. My book equity is now going to be different, much higher than it was. My return on equity, return on invested capital are all going to be different. So let's see how this plays out with SAP. My after-tax operating income with the traditional accounting, where I expensed R&D, was 1.285 billion euros. If I capitalize R&D, that operating income increases to 1.402. So I have higher operating income because I've taken R&D expense out of the expenses and replaced it with the depreciation, which is much lower. Will that always be the case? Depends on when a company is growing, flat. So you try it out. So if a company is growing, you'll always get operating income increasing when you capitalize R&D. So you take almost any tech company, you capitalize R&D, you're going to get higher operating income. And I value Tesla, I capitalize R&D. Again, for the same reasons. But I didn't give it a 10-year life, because if you're doing R&D, it's got to pay off much sooner in a company like Tesla. Second stop, when I look at the balance sheet, the book value of equity was 3.768 billion euros. That increases to almost 6.8 billion euros. So when I compute things like return on equity now, I'm going to have much more book equity because I've now brought your biggest asset onto the books and your book equity goes up. When I compute your capital expenditures, the traditional CapEx at Cisco at SAP was almost nothing. Why? Because they don't have land, building, equipment. But once I bring in my R&D, that jumps because my R&D was 1.02 billion and the depreciation was 903 million. My net CapEx has gone from 2 to 170. And finally, when I do my cash flows, it turns out that my cash flows remain exactly the same. Do you see why? As I capitalize R&D, my operating income jumped. That's the good news. My net CapEx jumped by exactly the same amount. You think, then why are we wasting our time? If the free cash flow is going to be the same, and the intuition behind why free cash flow is the same is, you're going to spend the money no matter what, whether I capitalize or expense it. You're saying, why are you wasting your time? For two reasons. One is, we want to get a sense of how profitable companies are. And the way we're treating R&D right now, we're not getting that measure. So when I compare the net profit of Microsoft to the net profit of GE, I'm comparing apples and oranges. With GE, that net profit is before capital expenditures. But Microsoft, I'm taking the biggest CapEx and shutting down. So that's kind of scary because you know the profit margin for Microsoft is 30%. But if I capitalize R&D, it becomes 38 or 40%. So it gives me a much better measure of what that marginal profitability is. Second, do we care how much companies reinvest? Yeah, if you're going to tell a growth story about a company, it depends on how much you're reinvesting. The way we treat R&D right now, I have no idea how much you're reinvesting because it's hidden in your income statement as an expense. We don't capitalize R&D to get a better estimate of the free cash flow of the firm. It's going to be exactly the same. We capitalize R&D to get a better sense of how profitable is this company, how much is it reinvesting, and finally, how well is it reinvesting? One measure of how well you're reinvesting is what kind of return are you making on your invested capital. We'll come back and talk about this measure. For SAP, in the old measure, the book value of equity was tiny, but when I almost doubled that book value of equity, I get a lower return on capital, but a more sensible measure of the return on capital. So if you go to my website, I'll actually send you the link. I actually have the return on capital and the margins computed for companies using traditional accounting, where leases are expensed and R&D is expensed. Then I compute the return on capital with leases capitalized, and with leases and R&D. And you're going to get numbers that shift, but numbers that I think are more relevant when you think about, hey, where's my value coming from as a company? And again, it's not just R&D that you should be thinking about. So before we go to the next thing, with R&D, with technology companies and pharmaceutical companies, that's your CapEx. With oil companies, exploration costs becomes the analogy you got to go. You know what it is with user-based companies? Companies like Netflix and Uber. What's a big CapEx? It's customer acquisition costs, right? Because they spend a ton of money trying to get new users. When Groupon went public, this was their big argument. You should not be expensing customer acquisition costs. But they did a half-assed job. Groupon said, let's just add it back, and we're really making money before customer acquisition costs. But if I made that argument as a user-based company that we should be capitalizing customer acquisition costs, there's one question you need to ask me that will tell you whether this is going to make a big difference. What's that question? I acquire a customer. What's the question you need to ask me about that customer? If that customer lasts only 6 weeks, then customer acquisition costs are an operating expense. If that customer lasts 6 years, now we have something to talk about, right? Because then we can do this. Now do you see why Netflix is in a much stronger position arguing that subscriber acquisition costs are a CapEx than Groupon was in arguing that you were, because a Groupon customer lasted how long? Until somebody else got your email, and there goes the competitive advantage, right? But with Netflix, we know that once people become Netflix subscribers, it's sticky. They have I think a renewal rate of like 96%, and the longer you stay on, the higher the renewal rate gets in. They get you addicted to you. Stranger Things. And where are you going to go next, right? You're going to say, I'll cut back on food this month. I'll eat once every 3 days, but I can watch you all the time. So you can see now how many shades of gray this introduces into accounting. But you need to do that in valuation because you can't just take the accounting numbers as a given. Right? Now let's talk about one-time and extraordinary charges. I don't know how many of you had a chance to look at the financials for your company, but a surprisingly large number of companies now have what they call non-operating expenses and one-time charges. Some of it is real, like when Boeing says, we had a one-time expense for the 737 MAX, in which case you say it's truly a one-time expense, or some of it might not be. Let me give you an example. Let's assume you have a company that's reporting a loss of 500 million, but it had a one-time charge of $1 billion, and you truly believe it's a one-time charge. What's your job? Not to assess earnings last year, but to assess earnings in the future, right? So when you sit down to project earnings in the future, what will you make your base? The loss, or are you going to add back the $1 billion saying, I'm going to act like it didn't happen? If it's truly one time, you could just remove it from the financials because it's true. So if you're looking at Boeing and you're convinced the 737 MAX is once and done, it's never going to come back, you can just take the loss due to the 737 MAX, add it back, and you're going to end up with profits, and you can say, I'm now okay. But what if you look at the financials for your company and you notice a one-time charge every year for the last 10 years? What do we call that? I call it a 10-time charge. And once you get a 10-time charge, I know you're playing games with me, because what you're doing essentially is taking operating expenses and figuring out ways to make it look like it's non-operating so that you can show it below the line. In the late 90s, in the peak of the dot-com boom, British analysts coined this term called EBBS, and it's not what you think. It's earnings before bad stuff. So here's how it worked. Companies say, our earnings before bad stuff this year was $3 billion, and guys, we had a lot of bad stuff happen here. There's $11 billion of bad stuff. And year after year, the bad stuff component got bigger. There's a lot of accounting game playing there. And the only way to detect it is for you to look across time and look to see if your company is the one that is creating these extraordinary charges year after year, at which point you have to stop and ask, maybe I should do something about it. So let me give you at least a vehicle you can use to bring that skepticism. So let's assume you look at this company and you notice it has a $1 billion loss every 5 years. Now, the previous example, you just added the billion back, right? Saying it's a one-time. Now, how would you adjust your earnings? You see $1 billion every 5 years. Let's play a common sense game. That looks like you have a $200 million expense that you're just lumping up and then claiming $1 billion write-off, right? So you know what you should do. You're going to add back 800 million, not a billion. Why 800 million? Because really 200 million of that is an operating expense that should have been here. Your starting profit then will be 300 million rather than 500 million. So this is the advantage of having financials for a long period, is you can see whether your company plays games and figure out ways in which you can push back if you think that game playing is out of control. And speaking of accounting game playing, sometimes you face accounting fraud. I don't think it's a rule. I think it's more the exception. Thank God for that, at least in the US. But there is a whole area of accounting called forensic accounting, which is perhaps the only part of accounting that's worth exploring deeper. You know what forensic accounting is? It's going through financial statements looking for clues that tell you whether people are cooking the books. I'll give you one very simple example. We all see accrual income, right? In the income statement, you're getting accrual income. But if you go to the statement of cash flows, there's a cash income, which you can see right under the operation side. It starts with net income, it subtracts out working capital, you get a cash income. It's accrual income, cash income. On any given year, one can be higher, the other can be lower, depending on what happened to working capital that year. One of the things forensic accounting has found is when you have a company where the accrual income is consistently higher than the cash income, you should start to get nervous because they're playing working capital games. They were using working capital as a way of making their income look higher. Remember, when you sell something as a company, you're allowed to post it as revenues and income. This is because the accrual income is when you transact. Let's suppose you sell stuff and you never bother to collect. Your income can keep going up. Your cash flows are going through the floor, but your income can look good. So forensic accounting is about looking for clues like that. None of them is conclusive, but a collection of clues you look at and say, that company, I should be worried about the numbers because the numbers don't make sense. If you get, I'll send you a link to a forensic accounting. There are a couple of very readable forensic accounting books that you can look at, which suggest, look for these 10 things. I'm not suggesting that any of your companies is going to be a potential accounting fraud, but you might at least want to check things like the cash versus because it's pretty easy to check. Okay? Which brings me to the money-losing companies. How many of you are doing money-losing companies? Come on, there got to be more hands up than this. There's got to be one person in every group doing a money-losing company. Somebody's playing games with me. So yeah, okay. So there are quite a few of you doing money-losing companies. You have perhaps the most difficult job in your group in valuation for a simple reason. You're underwater and you got to get above water. Okay? So here's a question I'm going to ask you, and since you picked a company already, you told me you did, you can help me. If you have a money-losing company, the first stop you need to make is stop and ask the question, why is my company losing money? And don't give me that because my expenses exceed my revenues. I know that. But why is it losing money? Because let's look at the potential reasons. It could be losing money because it had some kind of a temporary problem. For Boeing, you can say, well, it was a 737 MAX. So if you had a strike at your company last year, it was a strike. That is the easiest scenario to deal with because if it's truly temporary, what do we say we could do? Just act like it was never there, take it out of the process. It could be because it's a cyclical company and the economy is in a recession. Can't be a US company, but it might be a company in another country, economy is in a recession. Why is it losing money? Because cyclical companies in good times make a lot of money. It's not because it's unhealthy, but essentially the cycle. If it's entirely due to the cycle, the fix is fairly easy. What's the good thing about cycles is you go down, you go back up, right? And if that's going to be the case, and that's your only reason, here's what you can do. You can look at normalizing earnings. If your companies remain about the same size over time, you can normalize earnings by taking the dollar value across time, saying once the cycle comes back, I'm going to go back to making money. And if your company has become larger or small over time, you probably want to scale your earnings. To what? To revenues. So if you say, for instance, I'm an automobile company, and later on when we value Toyota, I'm going to do this, my average margin across the cycle is 11%. Right now, I might be losing money, but once we get back to a normal cycle, I'm going to make 11%. You compute your earnings as if you're making 11% today. It's a little dangerous because you're assuming that the only problem with your company is cyclicality. When the economy comes back, you're going to be okay. So if you're a money-losing company and you think this can be removed, you're normalizing earnings, cleaning up earnings. Your company will then look like every other company in your group. It'll be a money-making company. You can move on. But you could have a company that has a much deeper problem. It could be a company that because of where it is in the life cycle is losing money. Casper is losing money. Why? It's a young company. The business model is in flux. Uber is still losing money. Why? It's a young company. The business cycle is in flux. That's not going to go away. You can't normalize earnings for Uber. What's a normal earning? Normal earnings are what they're having right now. So you can't just replace a negative number with a positive number of those companies because it'll take a lot longer for them to dig out of it. It could be a company which has leverage issues. It's borrowed too much, and especially its equity earnings reflect the fact. So it's got a healthy business, but it's got way too much debt. Again, very difficult to fix overnight, but you might have to kind of coax them back to steady state and profitability. Or it could be a company which has long-term operating problems. The business has been disrupted, it's losing money, and there's no easy way back. You can't normalize that everything's going to be okay again. So if you have J.C. Penney and it's losing money, for God's sakes, don't normalize earnings. Say, if everything goes back to the way it used to be, I'll be back to making money, because it's not going to go back to the way it used to be. Here, your challenge is figuring out what your company will look like once it gets past the pain. Holding open the possibility that what could happen? That it might never make it there. So here you got to settle on what you think the operating margin will look like once it gets healthier. And those of you who went through my Tesla valuation could see how much of a fuzzy area this is, because I was trying to pick a margin for Tesla, and I could have picked the automobile company margin, which is 8%. I could pick the tech company margin, which is 20% plus. I could pick something in the middle. You're saying, which one should I pick? The story you tell about this company will determine where it ends up. You're valuing the money-losing company. You got to think about what this company will look like once the pain is gone. I'm not saying it's easy, but that target margin is what you will move towards. And you won't do it overnight. It will take time. It might take 3 years, 5 years, depending on your story. In my Tesla story, in 5 years, I'm giving them a 12% margin. I thought I was being pretty optimistic on this, but that reflects my story. So when you have a money-losing company, don't freak out, right? It's fixable, but you have to dig deeper to find out why the company is losing money, and what do you think will fix that money-losing problem. Yep. It's your horizon, or when you get to your, because once you get to your target margin, it's going to look like any other company, right? So you're asking, how will I know whether it'll happen quickly or gradually that you move to the target margin? Is that the question you're asking?
Or how long should we project that?
Not too long. Now, I've never done more than, personally, I've never done a valuation with more than a 10-year time horizon, unless you have a company like Aramco, where I valued it as a project of a 50-year life and there was nothing left. I didn't do more than 10 years ever, because if you're digging around in year 27, you've completely, you're out there. Then you're going to get really lost. Yep. Depends on the company, right? Depends on how deep the problem is, how long it'll take. So in fact, that's why if you open up the spreadsheet that I sent, I ask you when that'll happen. You can set it in year 5, you can set it in year 3. You talk of pathways to profitability. Every story has implicit in a pathway to profitability. Some have smooth pathways to profitability, in which case you're going to get there sooner. Some have more rocky pathways to profitability, where it'll take longer. So one number can't fit all. Some businesses will take longer, some will take less time to fix, but you have to fix the problem to make it a valuable company. So now let's talk about some of the other details in estimating the cash flows. Once you get the operating income, whether you fix it with the target margin or whatever else, yes, sorry.
I have a question on
Yeah.
capitalizing R&D.
Yeah.
Sorry,
Yeah.
So when you capitalize it and you amortize it for the life,
Yeah.
on the balance sheet, on the shareholder equity side, what would that look like? Are you kind of like a buyback or something?
No. Buybacks reduce shareholders' equity. This is like investing in a plant or equipment.
As you amortize it, don't you have to lower the other
Yeah, that'll come through the income, right? So you don't have to, because you're not directly writing off the book equity, you lower the income, and because retained earnings. So basically it'll show up in your shareholders' equity as retained earnings. So you don't really have to break any of the rules. You don't have to go into the balance sheet. It'll automatically take care of itself.
What was the name of the original count of the book?
You can call it whatever you want. You just call it R&D. After all, this is the nice thing about doing it yourself rather than have accountants do it. You can name it. You can give it your name. Put your name in front and say so that you own that asset. But really, it's really a reflection of how much capital have I tied up in that asset. So now let's talk about tax rates. Remember last session we talked about effective versus marginal tax rates? What did I say the marginal tax rate is in the US today? No, I'll come to you. What did I say the marginal tax rate is? 21% federal plus state and local, it's 25%. It used to be 40, it's now come down to 25%. And I also told you something about effective tax rates, that they're usually lower than the marginal tax rate or higher? They're lower. In fact, the average effective tax rate is about 19% right now. And when we talked about cost of debt, we talked about which of those two tax rates you should use, right? In the cost of debt, we said always use the marginal tax rate because it's in the last dollar of income. Now I want to revisit that question again, but in a different context. To get to my free cash flow to the firm, what's my starting point? EBIT times 1 minus T, right? What tax rate should I use on operating income? With cost of debt, it's no contest. It's always marginal tax rate. With operating income, should I use the effective tax rate? Should I use the marginal tax rate? Should I use a weighted average marginal tax rate? Should I use something in between? What do you think I should use as the tax rate to compute my after-tax operating income? Yes? Okay, let's carry that through. So let's say right now a company with a 15% effective tax rate, marginal tax rate is 25%. First, why am I using the effective tax rate here as opposed to marginal tax rate?
Because that's the actual amount of money that is going to.
But then I could have done that with the cost of debt as well, right? So there I use the marginal tax rate. So what's the difference? So when I did cost of debt, what is my rationale? It's on the last dollar of income because interest saves me taxes at the margin. Here, what am I looking at? All of your income. So the rationale for at least starting with the effective tax rate is this is all of my income, not the marginal income. So if I'm paying only 15%, I'm going to give them the benefit of the lower tax rate. But remember we said when you have an effective tax rate lower than the marginal tax rate, what are you doing? You're deferring taxes, right? So let's play a game. Let's assume you use 15% in year 1. I say, okay, you're deferring taxes. Year 2, okay, 15% in year 3, again. 15% in year 4, 15% in year 5. You get to your year 10 and you lock this in at 15% forever. Could you have a problem here? What happens to people who assume they can defer taxes forever? There's a padded cell in a federal penitentiary waiting for you saying, come on in. Because there's no way eventually it catches up with you as your growth starts to level out. Do you see where I'm going? I think it makes sense to start with the effective tax rate because you're right, people defer taxes. But as you move towards your terminal year, that last year, year 10, year 5, whatever it is in your valuation, you should try to move your tax rate towards your marginal tax rate. If you look at all of my valuations, I let you start with the effective tax rate, but I always move towards the margin, which is 25% around the globe pretty much now if you're a global company. Because my rationale is you cannot defer taxes forever. So the right answer is the effective tax rate, but with a caveat, which is it can't stay at the effective tax rate forever because that effective tax rate, if it's lower than the marginal tax rate, will create this deferred tax. Yeah?
If we pay tax at the effective rate right now,
Yeah.
shouldn't we pay the deferred tax that we deferred like 10 years earlier?
But the effective tax rate based on taxes paid, basically you might be paying cash taxes from 10 years ago, but it doesn't work. If you're growing, the two numbers will never match up, right? Because the deferred tax from 10 years ago are much lower. So that's what I said, as growth starts to level off, you're going to start to see your effective tax rate catch up to your marginal tax rate. As long as you're growing fast, you're going to get a gap between the marginal and the effective tax rate, even if you're paying the taxes from 10 years ago. Question from back there? No? Yes, go ahead.
I had a question about a young company.
Yeah.
So for a young company, for instance, Uber is at its money losing stage. So what steps would you take to normalize its earnings, assuming its operations mature?
If I answer the question, I'd value the company, right? Because what is it going to depend on? First you have to decide what business Uber is in. Is it a logistics company, a transportation company, a car service company? And then you got to decide what business model will evolve. Will it stay doing what it's doing right now, which is what? Keep 20% of the fare and essentially act as a broker? Or are they going to run their own cars? Do you see where I'm going? The story you tell about Uber's growth is now also going to determine what kind of margins they're going to have. If your story is Uber is progressively going to buy its own autonomous cars and put them on the road because then you don't have to pay a driver, that's the good news. The bad news is you need more reinvestment, but that story comes with much higher margins. Why? Because you run the autonomous cars, you collect a fare, 100% of the fare comes to you. So I can't answer the question unless I have a vision of Uber. So if you're valuing Uber, There is no way around telling a story first before you start entering the numbers. And that's why I keep emphasizing, without a story, you're going to get lost. Because that story is going to determine every one of the numbers, growth number, margin number, and reinvestment number. And I would say the same thing about Tesla. That 12% reflects my story, but you could have a very different story. So try to do it yourself, because in a sense you can think about doing it yourself for Uber as well at each step, picking your story and coming up with the numbers that reflect that story. So effective versus marginal tax rate. Everybody clear? So when you have a money-losing company, what's the effective tax rate right now? It's 0, right? So start with 0, but don't leave it at 0 forever, because then you're going to overvalue your company. So start with the effective tax rate, but always check to see whether you're moving towards a marginal tax rate in steady state. Yeah?
So I'm valuing not a money-losing company, but a company that's very young. It's only gonna,
So it's got low margins probably.
not low margins, just very low income. Like you said.
And low revenue, so basically it has to scale up. So your challenge in your story is scaling up. And whether as it scales up, it can keep making money. So in fact, your challenge is no different than a money-losing company. Just because you have a plus in front of your profits and a minus in front of it, no, you'll be facing exactly the same challenges of telling a story. Assets don't even matter in this story, right? Because ultimately in discounted cash flow valuation, what drives it? Revenues. So you'll have to figure out what you have to reinvest. It might not be in assets. It might be in customer acquisition. Taxes are such a small part of the story. Eventually taxes will play a role, but remember, it's a percentage of your income. Right now, you pay very little in taxes because very little income. As that number scales up, the tax rate. So the tax rate is what you input. The rest comes out of your views about the story. And for a money-losing company, here's how it will play out. And this is a little glitch with money-losing companies that you can be careful about. So let's assume you have a company that has an operating, right now, has an operating, after-tax operating income of $1 billion, $1 billion in net operating losses carried forward. Do you know what those are? You're a money-losing company now. You don't pay taxes, but it doesn't stop there. You're actually allowed to accumulate those losses and carry them forward till you make money. So let's say you cut your company at a cusp, where it's gone from being money-losing to money-making. It's expected to make $500 million in operating income every year for the next 3 years. But remember, you have $1 billion NOL you're carrying forward. When you value this company, you tell me how much you're going to pay in taxes in year 1, year 2, and year 3. I've kept the numbers nice and round, so don't pull out your calculator. You don't need it. What are you going to pay in taxes in year 1? 0. Why? Because you have a net operating loss of $1 billion carried forward. When you use $500 million, that net operating loss drops to $500 million. What about year 2? 0. So you're going to have 0 tax rate in year 1, 0 in year 2, and in year 3, guess what? The NOL's gone, your tax rate has to jump. If you look at my spreadsheet, one of the things I keep track of, if you're a money-losing company, and you might have wondered, what's this line item? Is your net operating loss, right? Because it's not just what you carry in, but if you assume that you're going to keep losing money, that loss is actually going to get bigger. That's probably the only good news about continuing to lose money. And then when you start to make money, I'm going to draw that loss down. And that's why for companies which have big NOLs and lots of losses, you might not see taxes being paid till year 7 or year 8 or year 9 because the NOL kicks in. So it's a little messy, but taxes are always messy. And you have to be careful that you're not leaving NOLs behind, because those NOLs can save you taxes in the years in which you actually start to make money. Net capital expenditures. Yeah, go ahead. See, in my valuation, you don't have to increase or decrease it. It's going to be in your cash flows, right? How does the NOL affect your value? In the first 3 years you make money, I don't make you pay tax. If you don't pay taxes, your cash flows in those years are going to be higher. It's already in your value. I hate post-valuation adjustments, right? Where you value a company and say, let me value the NOL separately. How can you value the NOL separately? The value of an NOL comes from the fact that you don't pay taxes. So I'd rather build it into the cash flows, which is what I'm doing. In which case it's already in your DCF value. There's no NOL adjustment you need to make. The people who make these adjustments often ignore them in their DCF, and then they have to factor in, but I have an NOL of $1 billion. Okay? This basically allows you to bring it into the cash flows. Okay? Let's talk about net CapEx. CapEx minus depreciation, right? Unfortunately, both are accounting terms, and when I say capex and depreciation, you run to the accounting statements. And which accounting statement are you going to see the information on capital expenditures and depreciation? It's not going to be in the income statement, it's not going to be in the balance sheet, it's going to be in the statement of cash flows. You'll see capital expenditures is something, increases in investments in property, plant, and equipment. Basically, that's where you'll see it. And if you stop there, and I've already laid the foundations for it, you're probably going to significantly underestimate what some companies are reinvesting. Companies like SAP and Pfizer, because your big capex is not going to show up in your statement of cash flows as a capex. It's in your income statement as an expense. But there's another aspect that I think we miss when we just look at the statement of cash flows. There are two ways a company can grow. One is to take a lot of internal projects, whether it's R&D or something else, and build up. But if you're in a hurry to grow, who did Morgan Stanley buy yesterday? They bought E-Trade. Why did they buy E-Trade? Because they want to get into online brokerage and they want to do it quickly, so they did an acquisition. I've never understood why we treat acquisitions as different from capex. An acquisition to me is a gigantic capex. It's the biggest capex you're probably ever going to make. Disney's biggest capex in history happened a couple of years ago when they bought Star Wars was only $12 billion. No. Fox. They bought Fox for $70 billion. A whole lot of crap to get to two pieces, maybe a piece of Hulu or whatever else they wanted. $70 billion. Which means if I look at net capex for Disney in 2018, I should be including that. You're saying that's going to penalize Disney. It's true, it'll make the cash flows negative that year, but that is the truth, right? You spent $70 billion. But if this is a good acquisition, how am I going to show the benefits? I'm going to show an increase in revenues, higher growth rates. So basically, if you want to count the good stuff from acquisitions, and everybody does, then I'm going to count the bad stuff by counting the acquisitions as part of my capex. Question?
What if the acquisition is non-cash-based?
Can we allow barter systems? I think that's a great question because companies use that. But we paid with shares as if shares were free currency. And that's a problem, right? Because they use this with management compensation. They put the notion. I tell people, look, you skipped a step. You see what the step was? If you'd issued the shares to the market, raised cash, and used the cash on the acquisition to be a cash acquisition, what you did was you did a barter system. You said, look, I mean, if we allow companies to get away with this, soon revenues will become profits. You know why? Because they'll pay for everything with shares. Employees' shares. That's not an expense. By Janet, I paid with shares. The guy who painted the mural I paid with shares. Okay? This is the kind of reasoning that allowed companies to use options like they were free currency and tell me not to worry. So it doesn't matter. Stock, cash, all acquisitions are going to be part of net capex, which means my definition of net capex is going to be much broader than the definition of net capex you get from the statement of cash flows. It'll include things like R&D for technology companies, exploration costs for oil companies, recruiting expenses for consulting companies. Do you see why? What's your biggest asset if you're McKinsey? People. And what you spend recruiting and training those people is the equivalent of capex. You're saying that's not allowed. Maybe not in accounting, but in valuation, that's exactly what I should be thinking about. And if you're a company that grows with acquisitions, I'm going to count those acquisitions as part of my net capex. Just to give you a sense of how much of a difference this can make. You guys familiar with Cisco? Now it's way back in time, many people don't remember, but Cisco went from being a $4 billion company in 1990 to a $400 billion company in 1990. The brief period was the largest market cap company in the world, 4 to 400 billion. That's a success, right? And they did almost all of it growing by acquiring small technology companies that they had like a SWAT team that would come down and convert promising technology into commercial products. So for 10 years, from 90 to 2000, they grew year after year by acquiring 15, 20 companies every year. So this was just 1 year. In 99, they bought 9 companies. You think what's purchase versus pooling? This is a strange accounting system that used to exist in the last century where if you used shares, you could qualify what was called pooling, which means you didn't have to show the goodwill. So they did 3 stock-based acquisitions and 6 cash-based acquisitions. It's kind of an indirect answer to your question. And they're big acquisitions. They actually paid for with stock. But when I look at the total amount they spent on all those acquisitions, it was $2.5 billion. I'm going to treat that as CapEx. I'm not trying to punish the company or reward the company. I'm saying this is what you're spending on CapEx, and then I'm going to look at your growth rate, and if you're doing the right things, I'm going to give you a much higher growth rate. So the net CapEx for Cisco in 99, here's what it looked like. The traditional, if I just stayed with the accounting statements, my net CapEx was 98 million. So if I just went to the accounting statement, CapEx depreciation, 98 million, almost nothing. You add to that my R&D effect. R&D adds another $1.1 billion because remember with R&D you have to add back the R&D expense and subtract out the amortization. My 98 million has now become almost 1.2 billion. And if I add to that the acquisitions, my net capex in 1999 was almost $3.7 billion. Again, don't view this as good or bad. This just means they reinvested a lot. Whether they're a good company depends on whether they reinvested well. That half I've kind of laid off on. But for me, acquisitions have to be looked at through a broad lens, not just through the accounting, capex, and depreciation line items. Which brings me to working capital. Now that we're shredding every accounting rule you've been taught, I hope you're not taking an accounting class because you're going to fail the class, because you're going to do the right things. You're going to move R&D to CapEx, and the accountant's going to say, no, you can't do that. So for the accounting class, put your accounting mindset back on, escape that class as soon as you can, because But in working capital, the accounting definition of working capital is, somebody give it to me. What's the accounting definition of working capital? Current assets minus current liabilities, right? That's not the definition you should be using in valuation. In valuation, what we call working capital is the difference between non-cash current assets and non-debt current liabilities. Let me take the two halves and explain the easier half first. Why non-debt current? If you go into current liabilities, you'd see accounts payable, supplier credit, short-term debt, short-term portion of long-term debt. You know what? I'm going to strip that debt out of and I'm going to treat it as debt in my cost of capital. So that's why I can't count debt. That's the easy part. You say, why non-cash current assets? Let me ask you a question. Why is there a cash flow effect from inventory jumping? Let's say you're let's say you run a small store and your inventory doubled last year. Why does that hurt you from a cash flow perspective? What is it about inventory that hurts you? You paid for the inventory. While it sits on your shelf, it does absolutely nothing for you. It's a wasting asset. If you sell items on credit, you don't charge interest. You show it as revenues, but it's a wasting asset. Inventory and accounts receivable are wasting assets. So when those go up, it drains my cash flows. So let me ask you a question. Is cash a wasting asset? Let me play devil's advocate. We talked about Google. Google has 120 billion in cash. How much is it making right now? Maybe if you're lucky, 1%. That sounds like a wasting asset, right? You're investing in 1%. Let me ask you a question. How many of your brokerage accounts in which some of your money is in cash? Today you're feeling really good if all of it is in cash. Take a look at what you earned last year on your cash. It'll make you weep. It's like basis points. I earned 0.05%. Why are you even telling me this stuff? It's just making me depressed. In other words, if you invested in something liquid and riskless, guess what you'd be making? On a really good day, you'd make 1%. Google has invested its 120 billion in something riskless and liquid. It's making 1%. You know what? 1% is what I should be making on something liquid and riskless. Do you see where I'm going? Cash, if it's invested in T-bills and commercial paper, which is what it's invested in most companies with big cash balances, is not a wasting asset because you're earning a return that you need to be making. That's why I don't count cash as part of working capital, because if you have Apple, 250 billion in cash, don't try to break into infinity loop saying, I'm going to find the 250 billion in cash, probably in currency in the basement. It's not there. Okay? It's invested in something liquid and riskless, and you can't get to it. Basically, it has a rate of return that it should. So what should be true for cash to be part of working capital? You have to be running a business where you need a lot of currency. Maybe if you're a Colombian drug dealer, and you say, can you value my business for me? Maybe you need a lot of stacks of currency around you. Maybe then I'd count cash. But thank God I don't have to value too many Colombian drug dealers. Right? But I don't see a scenario we're going to be adding big cash balances to working capital. I know there are these rules of thumb that people use that you should take 1% of revenues and treat them as working, they call it operating versus non-operating cash. Just let it go. Even if you need cash for operations, as long as that cash is invested in something liquid and riskless, commercial paper and T-bills, it is not wasting, you can ignore it. So when you think about working capital, a couple of things. One is how much detail you want to break it into. Remember we said don't break working capital into its individual components unless you have some special insight about inventory or accounts receivable. Just look at the total amount. Second, be ready for a lot of ups and downs in working capital. Working capital, if you translate year after year, you can see a year in which it goes up $1 billion, drops by $800 million. It's the nature of working capital. And sometimes you can have negative working capital. What does that mean? Your non-debt current liabilities are actually greater than your current assets. For a long time, this was one of the things that people, because usually if you're a retail firm, working capital has always been a big investment. You got it. First, Walmart changed the rules. Because when I took accounting, I was taught your current ratio should be 2. You know what that means? Current assets should be twice current liabilities. And Walmart came along and said, that's stupid. Why? And nobody really had an answer. It should be 2. It's always been 2. But for a retail firm, especially one growing like Walmart, you know what will happen if the current assets are twice current liabilities. Every time you grow, you have a huge amount of investment in inventory or working capital. So what did Walmart do? And this was way before computerization. They started tracking their inventory. So if you go to Walmart even now, somebody's always scanning, because they don't want inventory building up. And they also started using their market power to make their manufacturers carry the inventory. So it's your problem. When we need stuff, you just deliver. We don't want it on our shelves and pay for it first. And in the process, they made their non-cash working capital close to zero. You think how much of a difference does it make? It added almost $2 billion in cash flows every year to Walmart because they were able to keep their non-cash working capital close to zero. Then Amazon came along and they took the Walmart model and they kept pushing. You say, how can you go below zero? Early days, here's what Amazon would do. They'd sell you a book, collect the money, then go buy the book and send it to you. They were a book online retailer. So here's what had happened. Their non-cash working capital is negative, which meant that it became a source of cash flow rather than a drain on the cash flow. And once in a while, especially with technology firms, you will see this happen, is you get a negative working capital. Don't freak out. It's part of their business model. So when you do your cash flows as you go through, here's what you will see. As you grow, your working capital will get more negative. As it gets more negative, it will create cash flows for you. The only thing to recognize is negative working capital models have a floor. They can't keep growing and growing to become more and more negative because at some point in time they start affecting your credit risk. Because if you have billions of dollars in accounts payable, people start to notice. So even the Amazons of the world, it stayed negative, but as a percentage of revenues, it's become smaller and smaller. But you might have a company with negative working capital. It's not uncommon. And if you have that, then you could potentially get a cash flow from it. Any questions on any of those? I'm going to at least set up the free cash flow at equity, and obviously we won't have the time. Next session we'll dig into it. The essence of free cash flow at equity is what equity investors collect. So the lazy way of estimating free cash flow at equity is look at dividends, saying that's what it is. But in the next session what we're going to do is we're going to talk about potential dividends. How much could my company have paid out as free cash flow at equity? That potential dividend is what we're going to use to value the equity in a company. So I've set up the process. Next session we'll talk about estimating potential dividends.
A company I'm valuing is a foreign company, and it's really hard to. They only have 1 year of data.
So it's not that it's a foreign company, it's a young company.
No, it's not. But they just don't display the whole data.
But Capital IQ should have it, so why don't you use Capital IQ?
Capital IQ has
All the companies.
even their past,
Yeah.
even their form.
So try Capital IQ. Yeah.
I know you have a lot of understanding of net working capital. So my company, I'm valuing my company.
Non-cash working capital.
And there's only 2 shares, mine and my partner's.
Yeah.
Okay? So everything we make, we reinvest in the company. Everything. We never take pay dividends.
That's different. That's got nothing to do with working capital.
Okay, so my net working capital is zero.
Now, what's that got to do with working capital?
That's what I'm asking.
It's got one. You're talking about reinvestment. Net working capital is your inventory, your receivables, your payables. You buy stuff over nothing. It's part of reinvestment if it changes. But so one is a different
We
question.
haven't invested money since the
That's different.
inception.
That's a reinvestment question. Basically, a free cash flow to the firm is zero. Is it negative? Are you raising capital to cover your growth? Okay, so you're stopping at zero, which might be an interesting question. Are you constraining your growth because you don't want to give up equity? Because you stop at zero, there's only so far you can grow, right? So you can grow only whatever you create from operations.
I had in my pro forma analysis like the growth that we would have to raise.
So there you're going to see a negative free cash flow, right? Because you got to.
Thank you, I appreciate it.
Okay.
I know you're gonna send an email, but what section does the list go to?
Which will go to whatever we finish on Wednesday.
On Wednesday. Okay, so we'll know by Wednesday.
Yeah, in fact, it'll be the cash flow section. So it'll be the free cash flow to equity part, which will like 7 more slides. So that'll be the end.
Okay, cool. I was just studying that.
Okay.
Dumb and basic question, but Live Nation would
That's a very dumb and basic question.
would it be considered a service company? It's like
What's the
Live
company?
Nation that
Live
they
Nation.
sell.
Concerts.
Yeah. Thank you. Thank you so much.
Two questions. First, for the, I was going over all the class notes and lecture notes that you took over the past few weeks. For the assignment, are we supposed to be doing firm value or equity value? Just,
Can you buy or sell? I'm not quoting you.
Oh, okay. And second thing is, since we were talking about companies at a loss, the company I chose was profitable until the last
So your job is going to be easier than somebody who picked a company that's been money losing because you can then look at why it's lost money. Maybe it's a temporary loss, in which case fixing it is going to be very easy. But you met the requirements for it being money losing.
Oh, okay. That's all I wanted to know. Thanks.
So some airline companies, I believe, in even English, operate in sale leasebacks.
Yeah.
So for those, what
You
about?
still see the commitments in there. So if you have sale and lease backs, it's not airlines. The airlines don't sell aircraft back and lease it back. They don't have the capital to buy the aircraft. But it might be it's more common in real estate because there you try to sell and lease back on an existing building you own because real estate values have gone up. So the reason for that, doing that is you want to take advantage of the high real estate prices. So what you do is you sell an asset that's on your books, you collect the cash, but then now you've got to lease that building back. You don't need a contractual commitment, and as long as what you collect from selling the building exceeds the present value of the commitments, you're telling shareholders, look, you're better off because you sold the building, you got $2 billion. The present value of leasing it back in perpetuity is only $1.5 billion. That $500 million is yours. If you're taking advantage of the friction between the real estate market and the leasing market, and lease costs are not rising as fast as the property values. So sale and lease back usually don't see much.
Oh, maybe like what I was going to is the other part of the sale is like from the airline perspective. So they lease the airplanes and
That's
eventually.
the only part you get. The other part is the revenue. So if you're a lender, that's your business. The capital leases, so to them it'll show up as revenue.
Right, but then like don't airlines get the asset after I don't know 10 years of leasing it?
You can't get it won't be an operating income. This is a capital. It's already
Okay.
so you don't have to do anything. It's already be on the balance sheet.
Okay. Thank you.
Yeah.
much.